All right, now on to our provisional income formula and how Social Security is taxed. A lot of people don't realize, but if all you have on your tax return in retirement is Social Security, then you're not going to pay any federal income tax at all. And then also you're always going to get about 15% tax free, right? But then, based on your income or the thresholds that get applied to it, a lot of times you're going to end up paying more or pay a higher tax on your Social Security if you have other forms of income. So what they use is this thing called the provisional income formula. And basically what that is half of your Social Security plus any other ordinary income that you have, and then they throw in non-taxable interest income too if you have any of that, or dividends or capital gains. They're going to throw all that in there and say basically any other income you have plus half of your Social Security, and then they're going to lay some thresholds on top of that. And it's a little bit different for individuals as opposed to filing married, but then they're going to put that in there, and then they're going to say, okay, now we're going to lay these thresholds on top of the provisional income formula. And a lot of times advisors might say, hey, look, you don't have to pay any tax, or they'll say, hey, you have enough, nest egg, and we have enough money coming out of your IRAs, you're always gonna have to pay tax on 85% of your Social Security income. But sometimes for middle class and upper middle class, there's some things that we can do to mitigate that and maybe make it so that you don't have to pay as high of a provisional income tax. Now, the best way to do this is also to kind of do a story or a case study of something that's actually happened. So what I like to do for this one is say, okay, well, let's say we have a couple and they have $20,000 coming in from Social Security. They've got $40,000 that they're taking out of their IRA because they're trying to get to $60,000 a year to live on, right? So they've got $20,000 coming from Social Security. So how does that get taxed? You have to take half of that, which is going to say, okay, we're going to take $10,000 of that, and then we've got $40,000 coming from the IRA. So they're going to have $50,000 of provisional income because of that formula, right? And then they let you lay the thresholds on top of that, and then that's going to say basically, okay, well now we're going to have $11,100, or 55% of your Social Security is going to be taxable, right? Another scenario is that let's say you've got maybe $40,000 coming from Social Security, and then you only need $20,000 coming from your IRA, and then that's going to cause about $40,000 or $40,000 of your income to be part of the provisional income formula, because you got half of the $40,000, $20,000 plus $20,000 coming from your IRA. So even though intuitively you'd think, hey, I've got more coming from Social Security, so it's probably going to get taxed more, but that's not how it works. And then you lay the thresholds on top of that, so that's going to cause only $4,000 of your Social Security to be taxed, or about 10%, as opposed to the other one, the previous example, that about a little over $11,000 can be taxed. So that's the kind of loopholes that you have to look out for, or not loopholes, but that is the kind of situations you have to look out for in retirement, because all these different formulas and thresholds are going to cause you to pay a higher tax rate than is necessary, as long as you're doing a little planning or laying the tax code on top of your retirement income situation. So this is the kind of conversation about how or when to flip on your Social Security that you should be having with your advisor, or you should be studying if you're doing this stuff on your own. Or of course you can reach out to us, right? On to Medicare surcharge premiums, or excess premiums, because basically a lot of people don't realize this either until you get close to retirement and close to turning 65 and starting to use your Medicare, right? Everybody knows you've been paying into Medicare your whole life, so once you turn 65, you get Part A for free, right? Which is great. But people a lot of times don't realize, hey, you got to pay for Part B and D. Those amounts are going to be affected based on your adjusted gross income. There's a table of the thresholds, and if you have not listened to anything so far today, listen to this story that we've got. There was a couple, I like to use this story because it's fresh. I actually have quite a few of these, because what happens is if you're sitting on a large pre-tax account, a lot of times what happens, retirees will say, you know what, I've been paying the highest tax rate of my life, and then I hit 62 or 65 or whatever it was, because usually in your peak earning years, right, and your nest egg is as high as it's been. So then they retire and they're like, oh, perfect, I don't have to pay a high tax rate right now. I don't have any income coming in. We're just living off of our investments. We're gonna flip on Social Security, so on and so forth. But if you haven't done any planning, people are like, oh, right, this is great. Our tax rate is, 10% or 12%. It's lower it's been, since I was a teenager or whatever. But what you don't realize then is if you have a retirement nest egg, and then when you kick on, when you have to get into RMDs, where you have to start taking money out, right? And even if it's been pushed back to a later date, the amount that you're going to have to pay when it kicks on, whether it's 73 or 75, is going to be higher, because Uncle Sam still wants their share of the money, right? So what happens is, and here's a perfect story. My cousin, he was talking to me about his in-laws, and They've done great. Money's not the problem. They both have pensions, retired from a great company. They both have pensions. They've done well saving. They've been, they've done what they want, but they're savers. They've done very prudent investment-wise, have a good pre-tax account, but they've never laid the tax code on top of their income. My cousin's father-in-law was telling him, hey, we have to start taking RMDs next year. They're gonna be 73, so we're gonna have to start taking RMDs. So they've been happy with how low their tax rate's been since they retired, right? But now they're gonna have to start taking required minimum distributions next year. And he told them, he's like, man, that's gonna kick us up into the 32% tax bracket. And so they've been excited. They've been retired like 8-10 years. Clearly, they're not clients of our firm, but what happened is they retired, they tried to have a super low tax rate, and now RMDs are gonna kick in next year. And not only are they gonna be in the 32% tax bracket, but this is gonna kick them up about 4 or 5 brackets on the excess premium or the income related monthly adjustment amount that you have to pay in Medicare. Not only are they gonna pay a 32% tax rate, which is higher than they needed to pay if they had done some proper tax planning, but they're also gonna have to pay over almost $12,000 a year extra in Part B and D premium in their Medicare. And even though your tax rate's higher than it needs to be, when people find out that they're gonna have to pay that premium that usually can be that much higher every single year on your Medicare, that really irritates people. Like what I found out is they're like, oh, why didn't my advisor tell me this? Or man, I wish I'd have done more research, or whatever it might be. And I say, yeah, that's a lot of money just going to Uncle Sam because, unfortunately there wasn't some proper tax planning done. So remember that story, because if you're sitting on that big pre-tax amount and then you're not doing anything tax-wise in your gap years, whenever you have to start taking money out of your RMD, it's gonna cause your adjusted gross income to go higher, and you're not only gonna have to pay a higher tax rate than you probably needed to, but you're also gonna have to pay an excess premium that could be, another 5, 6, 10, 12, or even a higher amount a year, $1,000 in Medicare surcharges. So definitely keep that in mind, because that one really bothers people for other obvious reasons. Why do you want to pay $12,000 more a year in Medicare than you needed to? Because what you need to do is some proper tax planning and laying out a tax map and having an idea of what you're going to do. So do some proper planning with a tax advising professional to make sure that you're laying the tax code on top of your retirement income situations. And if you would like to see how we help our clients get the most out of their financial lives in retirement, please visit us at erwealth.com, and we hope to see you there.